Hey, this is Cedric Youngelman, your host of the Bitcoin Matrix podcast. Today's episode with Lyn Alden, the prominent financial analyst and investment strategist known for her insightful research on various investment topics, including equities, macroeconomics, and particularly Bitcoin, is brought to you by the Bitcoin Advisor. I'm thrilled to join forces with Peter Dunworth and Andy Pattison at the Bitcoin Advisor, along with the Bitcoin Matrix podcast, to bring you even more incredible insights and support on your Bitcoin journey. At the Bitcoin Advisor, we're helping clients with their multi-sig setup to buy and secure real Bitcoin for decades to come, while ensuring you can sleep at night with the right estate planning and asset protection strategies to make sure your Bitcoin is safe for you and your family. We're here to help you get your Bitcoin off exchanges, simplify the process, address your Bitcoin challenges, and ensure you feel confident every step of the way. If you or someone you know needs help buying Bitcoin and creating a multi-sig vault, we're here to help. Ready to dive in and learn more? Simply head over to thebitcoinadvisor.com/Cedric. Then head over to River. Why is River the best place to stack sats and build your Bitcoin wealth? River has zero fees on recurring orders. All Bitcoin is backed one-to-one in multi-sig cold storage. Your Bitcoin is your Bitcoin to withdraw in full at any time. River builds and owns their own infrastructure. River has US phone customer support. This is where the Bitcoiners are going for a new standard in Bitcoin. Buy and build your Bitcoin wealth with a Bitcoin-focused company that has a Bitcoin ethos that has been built for generations to come. Buy and build your Bitcoin wealth with a Bitcoin-focused company with a Bitcoin ethos that has been built for generations to come. Use the link in the show notes to get started and get $5 in Bitcoin when you sign up today. Hodler's Official is the team Bitcoin merch and memorabilia company for Bitcoin's biggest fans. Their first Team Bitcoin jersey collection is appropriately named the Genesis Collection, commemorating January 3rd, 2009, the day Satoshi mined the Bitcoin Genesis block. Featuring the 09 number on the back with Satoshi on the name bar. This is a limited edition set. Only 2,100 jerseys from this Genesis collection will ever exist. You may have seen them online or at a bunch of Bitcoin conferences this year. Super high quality, sharp design, fits nice and true to size. Great gift idea for your friends and family that love Bitcoin. They also do customs specifically for Bitcoin companies. If you have a Bitcoin company and you are thinking about what to get your staff for Christmas, this is an awesome corporate gift idea. They will work with you on a design, pick your material, polyester, cotton, and make sure that they are delivered on time. Go to hodlersofficial.com today and get your Team Bitcoin gear. Use the code MATRIX for 10% off your entire order. These jerseys are so fresh and dope. I'm wearing the away jersey right now. And now, let's enter the Bitcoin Matrix with Lyn Alden for an in-depth conversation about her awesome new book, Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better.
What is real? How do you define real?
You can't jump into cash. Cash is trash. What do? You get out.
Lyn Alden is a widely followed macroeconomic analyst that provides research for retail and institutional investors. Her focus is on the analysis of monetary systems and energy markets. In addition to her awesome new book, Broken Money, and her research publications, Lyn also serves on the board of directors for Swan and is an advisor to the venture capital firm Ego Death Capital. In these roles, she works with investors and startup founders to help build the next generation of monetary technologies and financial services. Lyn's background consists of a blend of engineering and finance. She holds a bachelor's degree in electrical engineering and a master's degree in engineering management with a focus on systems engineering, engineering economics, and financial modeling. Prior to her current work, Lyn spent over a decade in the aviation industry in a variety of engineering, procurement, and managerial roles. She has appeared on programs such as Yahoo Finance, Fox Business, Macro Voices, What Bitcoin Did, and Blockwork, and has been cited by a variety of financial publications, including the Wall Street Journal, the New York Times, the Globe and Mail, CNBC, Reuters, Forbes, Fortune, and Barron's. She has spoken at the Oslo Freedom Forum, Princeton University's Dissenter, and the Stevens Center for Innovation in Finance at Wharton, as well as a variety of investment-focused and technology-focused conferences. Lyn Alden, welcome to the Bitcoin Matrix podcast. How are you?
I'm good. Happy to be here. Matrix is always my favorite movie, literally since I was a kid. So I couldn't turn down being a part of this podcast.
That's right. I remember you had a tweet about the Matrix maybe 6 months or a year ago. And yeah, this podcast has been, or this episode has been a long time in the making. So I definitely appreciate you making the time to speak with me after releasing your awesome new book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. I guess we'll start with The Matrix. Why is The Matrix your favorite movie?
So part of these things are always luck-based. I mean, I was probably 12 when The Matrix came out. And so it kind of, the action, the mystery of the whole thing appealed to me. But there's a lot of movies at that time that were appealing. But that's the one I went back to over and over again because I consider it kind of the perfect action movie in the sense that it's well written, it's well acted, it's got a good plot. Just it's well filmed. It's good visual effects for its day that they still hold up literally over 2 decades later. It's just like a phenomenal movie kind of from front to back. And it's unfortunate that they did not carry it through to their sequels. There was a degrading quality to the sequels. I kind of pretend there's only one Matrix movie. Really, I guess the second best is the second one, but really it just kind of went downhill from the first one. But the first one was almost a perfect movie. It was basically a perfect movie. And it kind of it's so unique, basically. It's the marketing for it at the time. And the funny thing about movies is like, if you watch them decades later, years later, you don't know the marketing for them at the time. You don't know what it felt like when they were coming out, right? But Matrix was one of the movies that it was late enough that I still remembered what it felt like when it was coming out. And the advertising was just basically like, what is the Matrix?
Right.
And it was like a question. And you're like, well, I don't know. Like, I don't know what the Matrix is. Nowadays, trailers give away the whole movie before you see the movie. Back then, they would show some really cool scenes and stuff, and they would say, what is the Matrix? And they would have like dialogue of Morpheus being all like cryptic and like kind of like trolling Neo and be like, what is the Matrix? Do you want to know? And of course, you want to know. And the combination of how it was brought out, how it was written, how it was acted, executed, just utterly flawless, holds up well for 2+ decades. Haven't seen a better action movie. Haven't seen a better just kind of overall exciting drama movie. It's not like some like deep, it's got like a depth to it that rivals drama movies while being a fun action movie, which is why it spread so many genres. Morpheus was one of the best characters ever written. Trinity was great. Keanu Reeves is not, he's not exactly known for his like diversity of acting roles, but he's perfect in the roles he's well casted for. So he couldn't be better. Like there was originally they were gonna have Will Smith do it, and Will Smith is awesome, but in that role, Keanu's perfect. And then Agent Smith was amazing. Like just like basically like the cat and Cypher was perfect. Both the writing and the acting. It's almost like just like everything came together to make a perfect movie. And then Bitcoin almost breathes like a second life into it. Like so all the sequels kind of were bad, but Bitcoin is the real sequel because basically we're living through the Matrix now, which is why I think this podcast is relevant, which is that when you have a problem that is literally all around you, you're born in it, you never imagine a world without it, which in our system is our money system. It couldn't be a better analogy. And so the fact that the best Bitcoin memes are Matrix memes is not a coincidence. It's literally a perfect like one-to-one matchup. And so literally it's like I love the fact that it kind of revives my favorite movie in the modern era.
Wow. Yeah, well, this podcast was definitely inspired, especially the name, by The Matrix, the movie. And I agree with you that I don't really count the second and third one as well. And I think you made astute points there. So then I have to ask you, what was the inspiration for writing this book now?
So a lot of it was timing. I had written years of long form articles, and I got natural questions like, do you want to write a book? And the problem with writing a book is that it's time consuming, unprofitable. It's just kind of a pain in the ass. So it's kind of like you should not write a book unless you feel like you absolutely have to write a book, is kind of the advice I would give. But I crossed the threshold where I feel like I had to write a book. The main issue was that I had a number of points I wanted to make that were like not sufficiently covered in one article. Like money's a complex enough topic that you have to walk people through it. Just like the matrix there's no easy way to tell someone what the matrix is. If you tell someone what the fiat matrix is, it kind of takes a book. Like you have to, or a number of books, but like a minimum one book. Like you can't just one article is not going to do it. And then if you say, okay, read these 5 articles, they're all kind of written for different times, not really written knowing that they're going to flow into the next article or knowing that they're going to flow from the past article. So they're going to be repetitive. They're going to be incomplete. And so the combination of putting a bunch of thoughts together that are neither too repetitive nor incomplete kind of requires a book. Combined with a couple major themes I wanted to focus on that I felt like were not covered in other either money books or Bitcoin books is why I wrote it. And then the selfish reason is just like, there's like a kind of a low time preference idea of wanting to like timestamp something physical, like you work on blogs, you work on venture capital, you work on things like that. And, you want something physical out there, maybe something that, that might be caught, there's, tens and tens of thousands of copies of it. There's digital copies. It's a known work. It's nice to have something out there that's kind of modular that just kind of shows it kind of like timestamps my views at this time.
Yeah, well, it's an incredible piece of work, and it threads a complete idea throughout the whole text. And so I kind of wonder, how do you manage to stay unbiased? And what do you mean by, sculpt your own reality?
So I think those are two separate questions, but for unbiased, I think I'm lucky in the sense that I have very different audiences. So if you find yourself speaking to different audiences and you know that anytime you speak, both audiences will be listening, you have an extra threshold on yourself to not just be audience captured. There's some people that might want to speak to a certain view and they build an audience entirely around that view. So they kind of bias themselves by default. But because my research is not specifically Bitcoin oriented, it's not specifically crypto oriented, whatever, it's not specifically, equity oriented. It's just kind of like investment, finance, money, energy, right? It's kind of like anything tangentially related to economics. And so I get to focus on whatever's interesting. And so that's I'm lucky that I'm simultaneously every time I write, I'm always thinking like, what are like hardcore 10-year developers of Bitcoin going to think about this article? What are, executives at financial institutions going to think about this article? Because literally both types of people are reading those articles as well as everyone in between. What is a upper middle class engineer that just, he spends most of his time at work and he wants to know how to invest his money. He's reading my work. What is he going to think of the article? Right. And so that like thinking about how multiple different minds will perceive my work helps it be less biased. I think like what would the critical person of multiple different camps think of my work? What would I think if I was in their shoes, what would I think? If a person on the right, if a person on the left, if a person from this country, that country, this profession, that profession, uh, you know, uh, institutional pleb, whatever the case is, what would they think reading my work? I try to kind of go through that. As far as my recent tweet, like shape your own, sculpt your own reality, it's that the the one downside. So the major theme of the past couple decades is that software has brought down the gatekeepers. So it's brought down the book publishers, it's brought down the media companies. We can now right now we're doing it like basically a peer-to-peer, TV show, radio show. You can do peer-to-peer books. Um, And with Bitcoin, you do peer-to-peer money, and with crypto, you do peer-to-peer securities, basically. So all these things are gatekeepers going down. Most of that is good, but of course, if you bring down the gatekeeper, you also let in the low quality long tail of stuff, like just bad quality stuff. And that's also why crypto is bad because, if you listen to a bad song or a bad book or a bad show, it's not the end of the world. But if you invest $10,000 into a bad, like a Ponzi, that can actually affect your life for the average person. So there's gatekeepers have different meanings, but basically, without a gatekeeper, without like a shared kind of media reality, we all are forced, for better or worse, to build our own media reality. But because of large platforms and their algorithms, and because of just naturally coalescing tribalist trends, we tend to consolidate into people that just always agree with us. And people don't seek out people that disagree with them. And so my point with the sculpture reality was, don't let the algorithm define you. Go out and pick your algorithm. Most platforms have ways to sculpt the algorithm if you know how to use them. You can work around the algorithm. You can purposely kind of seek out things that the algorithm is not selecting for you. You can use multiple different platforms. And I just wish more people would do that more consciously, basically take the red pill, more or less.
Well, I thought, the book was high quality, thoughtful, balanced, rational, and something I'm trying to describe, and I just don't know how to maybe articulate it, is that it just had this sort of low time preference outlook, or it just didn't jump to conclusions, and it drew very sensible conclusions. And where I'd like to start is, how are ledgers the foundation of money?
So a big theme in the book is to try to kind of reconcile two different types of money, two different monetary theories. And what you'll read in most Bitcoin books or Austrian books or just kind of, books in this kind of genre is to focus on commodities and money. So, uh, you know, we start at shells, and then as our technology gets better, we gravitate towards gold as the highest stock to flow commodity. And that's fully accurate. Literally, Aristotle discussed this back, millennia ago. Adam Smith talked about it. This has been a long-term, like intuitive theme. One of the challenges is that anthropologists have taken time to challenge that kind of assessment and order of events. You'll see generally, like in Adam Smith's work, he'll be like, yeah, so there's a butcher and the baker, and they were kind of like frustrated. How are they gonna like do a commerce with each other? So then they invented money, and that's kind of the train of thought you get into, and it's a useful thought exercise. But when you actually do the research on how hunter-gatherer societies form, how primitive societies form, money comes before specialization. So you never have a case where like a butcher and a baker exist and yet don't have money and are like frustrated at this fact. It's just not, it's like a thought experiment that just doesn't come up in reality. And so it turns out that they solve that while they're still primitive before they ever get to that point. And one way they solve it is the commodity theory of money, which is things like shells or eventually gold. But the other way is through credit to say, you know, at the end of the day, there are two ways to solve the double coincidence of wants. Like if you want to trade, if you have extra furs and need spears, and I have extra spears but need furs, we're like lucky that we found each other, but that's unusual. And so there's two ways if we want to have more options to trade with each other. There's really two ways to do it. One way is that if either of us needs something and the other one does not need something and has surpluses, we can defer that over time. So like if I need something and you just like give it to me and say, okay, next time I need something, maybe you'll be in a position to help me back, right? And so now I feel like I owe you, and we're social animals, and so like I know you and I feel like I owe you now. That's one method, especially if we like live in a similar region. The other method is the basically the commodity theory, which is we standardize most transactions with one particular commodity. So we instead of valuing everything against everything else, we always just take one super commodity, whether it's shells or gold, as that side of the transaction. And so both the credit theory of money and the commodity theory of money come from the same root, which is two ways to solve the double coincidence of wants. And the way that I kind of rectify them is to say that ultimately these are all just ledgers. If I'm trusting you I'm trusting our shared two-person ledger. Like I'm trusting that you're going to remember the ledger that we did, or you're trusting that I owed you. If it's a 10-person group, we're trusting that ledger. If it's a 1,000-person regional group, we're trusting that human-controlled ledger, like the temples of Babylon. And then if we go more abstract and we talk with people we don't know, then we're trusting nature as the ledger. We're saying, I don't want to trust people. I want to trust nature. So I'm kind of trusting that I look at how many shell beads are in this region. I know how hard they are to make. And so like we're kind of treating all shell beads as a ledger. We know how hard they are to add new shells to the ledger, and we can update the ledger by physical possession. And so we're saying instead of letting humans do that ledger, we're going to let nature do it, or gold coins, whatever the case may be. And so ultimately, money is the savings and payment and unit of account of a ledger. And it could be human controlled, it could be nature controlled. In recent terms, with Bitcoin, it could be kind of user controlled, distributed. There are a bunch of different ways to do it, but it's ultimately about, what is the shared accounting system that you're all agreeing to and why?
Right. I like this reconciliation between credit and commodities and looking at money from both those perspectives and unifying it. Another topic that you bring up in the book that I'd love for you to expand on is the ledger is how do you think of it in terms of flexibility or being inflexible?
So, and that's one thing that's like kind of in modern times is relevant because generally you'll see credit theorists want it to be more flexible. Um, the more flexible it is, the question I return to in the book over and over again is who controls it. It's not the primary question is not is it flexible? The primary question is who controls it. But if someone controls it, by extension, it's likely flexible. If it was not flexible, no one would control it. So really, I think the principal question is who controls it. And so that comes down to it could be nature in terms of gold. It could be a bank if you're all entrusting your gold to the bank. It could be a central bank or a nation state if multiple banks and people are all trusting their ledger to that nation state or that central bank. It could be a local community. If you have a small town and the 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 baker gives credit to the butcher and the butcher gives credit to the flatcher, the blacksmith, and like, they all kind of have this like local credit system. You're kind of relying on the local, judicial system to enforce any of that as well as just social norms. You're always relying on some sort of ledger. And in the modern era, because ledgers have become so centralized and abstracted, they're highly flexible, which means that a rather small group of people can dilute you out of your savings and or can censor your transactions, and both of which are highly relevant in the modern era.
Right. And I love how this thought of sort of the flexibility of the ledger, and you can put promises on the ledger, and you can make, the ledger can get to a point where it can have be overpromised or overextended past what the natural ledger would permit. How did the telegraph or the speed of telecommunications change money?
So what that did was it created a historically unusually wide gap between transaction speed and settlement speed. Prior to the telegraph, there were very limited ways to send information long distances more quickly than human travel. You could do fire signals in the night or things like that, but that was a low bandwidth, super low bandwidth. So for the most part, if humans wanted to send information, they had to go on horse or ship to get it there quickly. So basically, matter and information traveled at roughly the same speed, including ledgers. Like, you couldn't update a ledger over long distances faster than humans could get there and explain what happened. But in the 1830s, the telegraph was invented, and by the 1860s, it started to be widely deployed intercontinentally and cross ocean. And so all of kind of the Western world, and then eventually the whole world, was linked together in the telecommunications era, which is that they could send transactions at the speed of light, but physical money, gold, still settle at the speed of matter. And that, technically you can send things in a couple days, couple weeks overseas, but also then you have to verify it. How do you verify a pallet of gold? You have to kind of melt it down to the core and reform it if you want to be 100% sure. that gold is what it is. And so it's both costly, slow, time consuming. I mean, even in the modern era, Germany decided to repatriate its gold from the US. And it was like literally a multi-year process, which is kind of comical. Like, it took them years to do it. Like it should take what, weeks, like at most, to like, like securely transport a couple $1 billion worth of gold. But it was like a comical amount of, it was years of time. And that just kind of shows the challenge. And so basically during that telegraph era, they needed to speed gold up. And so they already, like, banking was already about trying to move gold and silver more quickly and conveniently and divisibility wise than it was. And there's already a gap there. But the telegraph just completely exploded that gap. It basically added a 10x to that gap and made it so that gold and silver were now completely untenable for global commerce as they were. And so they had to be sped up. And the only way known to sped them up was basically say, okay, here's this big ledger. It's a bank or a central bank. And they're gonna move accounts around, who owes who how much gold. And that's what happened. And of course, the problem is that if few people ever would take their gold out, and some central authorities are able to determine the gold ledger, they're going to rehypothecate it. They're going to double count it. They're going to triple count it. They're going to quadruple count it. One of the sources I cite in the book was from 1875, and it was already counted 20 to 1. They were already, by the time the international gold standard was like in effect, it was already unstable. And that's just in large part because gold was too slow to ever challenge that system. And so it was able to build more and more leverage on it until some crazy catalyst broke it, like World War One.
So getting up to World War One and kind of near that time frame, before we jump into that, maybe what did Keynes think about the dangers of using a ledger that other people control?
Well, that's ironic because he was a proponent of doing exactly that, but he wrote some things after World War One. So after he saw some of the perils of it, he warned that the problem of inflation is not just that value is taken from you, but that it's taken from you without you knowing. And so the difference between inflation and tax and why governments often turn to inflation is that, the tax, if they say, hey, we want to go fight these like other people in another country, we're going to tax everyone by 10%. And you think, why do I have to give up? Like I'm working 12 hours a day. Why do I have to give up 10% to go fight these people I don't know? But instead, the government just says, we're not even going to tell people. We're just going to as we just generally tax the base amount, we're going to dilute the coinage, give them back, cheaper coins, and use the difference to go fight this war. And that was like old debasement. And now when you have telecommunication systems and banknotes, you can cut people's currency in half overnight rather than over years, or you can divide it by 90% in a week. And so inflation, being able to dilute the ledger is a both centrally given like a tax, but unlike a tax, it's super opaque. And that's actually why this whole thing, literally the Matrix is literally a perfect analogy, because the reason the Matrix works is because you don't realize that you're in the Matrix. Even in the Matrix, they just the architect is talking about how like they originally decided that they'd be like utopian matrices, and they just didn't work. But the whole point is you're in the Matrix. It's realistic enough that it feels real, but it's just not real. And an inflation tax is kind of like that. You're in an environment where you don't even know you're in it. And nothing makes this more real than living in a developing country for a period of time. Not just traveling there and going to a resort, but actually living there and knowing the people there. Because if you go to a country, a point I make in the book is that there are 160 plus different currencies in the world. Each of these is like their own little matrix. They all have a firewall around their borders financially, which is mostly meant to prevent money from getting out, because ideally money wants to go out to better jurisdictions for most of them, the long tail of weaker areas. And so everybody's stuck in this matrix in their own little like 160 different matrices. And for example, if you're in Egypt, you have 20% annual currency devaluation, so 20% annual currency supply growth. Your the capital every year you have to try to get a 20% wage increase, otherwise you're being diluted. You have to figure out what you can do with your savings every year. The Egyptian stock market is not exactly fantastic over the long term. Real estate is illiquid and challenging, but that's what a lot of people turn to. Dollars are hard to get. Gold comes at a big giant premium. And so they're basically in their own little bubble. And it's hard to even know that's happening to you. That's kind of by design, and that's repeated in Argentina, Turkey, Lebanon, Vietnam, Thailand, and then to a lesser extent, Canada, France, the United States. It's just more it becomes more obvious in developing countries, when you weren't born there. And to some extent, even if you were born there, I mean, they catch on quicker because it's just mathematically it's obvious. It's less obvious in developed countries, and that's kind of the trend that we've been stuck in. That basically taxation is opaque, and literally 100 years ago, even Keynes, who's supportive of this, pointed that out. Arguably, that's why he liked it.
Amazing, the irony. Can you describe China's century of humiliation and what that was about?
So in the mid 19th century, they were invaded by Europe, Britain, France. I am by no means a detailed history expert, but basically, as the Western powers kind of like spread worldwide, they eventually invaded China. They wanted to trade with them. They used opium they purposely injected opium in there to try to destabilize the society. At the same time, like for example, the United States was pressuring Japan to let them in for trade, basically saying like either let us in or you're gonna have a problem. And so China and India both historically were very large percentages of global GDP. Now, of course, throughout most of human history, GDP was more isolated. You had things like Silk Roads and maritime roads, like routes. But basically, China was a very large power. It fluctuated over time, but they collapsed as a percentage of GDP compared to their normal baseline and normal population as a result of being basically defeated by the Europeans. And then as Japan rose to power, they also went and conquered China. And the war crimes there literally rivaled what Nazis did to anyone in Europe. I mean, the war crimes in Asia are often just not covered as much as what happened in Europe because we have a very Western centric view of history. But that region was just completely rife with horrible war crimes. And so China was just devastated, but on it was like a 1-2 punch. And then of course they in their like horrid state, they ended up embracing communism, which spread to them, and that didn't work out either. So that was like their own self-imposed like third punch. And so they just had, but they just had a terrible time. And so what we're seeing in large part now is that, in the past 4 decades, starting in the 80s, they decided to emerge partially from their communism and start having more market-based economies, while also having a firm eye towards trying to recoup what they previously had. And, I'm not a fan of China's model. There's a lot of human rights abuses there. They're exporting surveillance and control. But at the same time, if you put yourself in their leadership's perspective, they're saying the West crushed us and then contributed to us losing so much. And so we're going to do anything it takes to rebuild back to like the status on the global stage that we earn, which is, 20% plus of global GDP and a regional power that's in control of their own destiny.
Wow, astounding. I want to read a piece from your work or quote. While politics can impact how we interact with money locally and temporarily, it's technology that impacts how we interact with money globally and permanently. As new technologies come into existence, certain types of ledgers become obsolete and go extinct, while new types of ledgers are born and become necessary. That's why new forms of money tend to be adopted rather globally rather than just locally. What happened with the Bank of England and war bonds and the Financial Times and trying to raise money for World War I?
So it's funny because there's actually two parts there. I mean, the Bank of England was founded in the late 1600s because the government wanted to finance war, but that's a different story. What happened in World War One was kind of the beginning of the Fiat era and the end of the gold standard era. And it was kind of an inevitable result of what happens if you leverage things 20 to 1 because you're trying to use gold as money, but you're in an age of telecommunications and complex paper instruments. So what happened was, you know, Europe was from 1871 up until 1914. Europe was in a state of unusual peace, and they had the gold standard. It was kind of a period of proliferation. And you had Germany as a rising power, but also one with a lot of trade connections to the UK. So kind of like the US and China today, you had rising powers, but also your supply chains were heavily intertwined. And there were some rising tensions. And of course, people were like, war is impossible. These powers could never go to war. And then you had an assassination in Eastern Europe based on, I won't go into details, but person XYZ doesn't want this other country to control their own territory. That, then there's like military alliances kind of coalescing. But what's interesting about the UK is that as multi-country war broke out across continental Europe, the UK did not have to join. They didn't have any pre-existing military alliances. They were not forced to join. But they looked at it and said, we don't want Germany to defeat France too badly because then Germany might control all of continental Europe and might surpass us in size and scale. And so we have to go send money and people to die across the water onto this continent to go stop this power for strategic purposes. Even though, of course, any land invasion is very hard. UK was well protected from Germany, even should they get bigger, but they wanted to kind of nip it in the bud. And so they said, okay, we're gonna go join France and Russia, and we're gonna go defeat the Germans and the others. And so we're going to raise a bunch of war bonds to do this. We're going to tax some, but we can't, you can't realistically tax too much because people will revolt. So we're going to raise war bonds. And the money for the war bonds did not come in. Only about a third of it came in. And so they literally just didn't have the funds for war. And so they instead just literally outright lied and said, hey, it was oversubscribed, money poured in. But what they really did was went to the central bank and just had them print the money, more or less. They basically had them lend a line of credit to their own officials who then bought the war bonds completely, just fakely. And they just printed the money. And so instead of taxing or raising voluntary funds from the public to go fight the war, they just diluted the savings of every Briton and the ongoing wages of every Briton. And then also because the UK was the world reserve currency at the time, they went and devalued the savings of tons of developing nations throughout the world that were holding, UK bonds, UK notes, all these things. And so they just opaquely funneled savings and future wages towards this war in continental Europe, which did not immediately affect Britons, which certainly did not affect people like the South Pacific. They were just, either colonized or voluntarily holding UK assets. And then ironically, it arguably made the whole thing worse because World War II would likely not have been what it was if not for World War I. The whole rise of the Nazis, for example, was because of how badly Germany was beaten. And, it's hard to have a counterfactual for what would have happened, but there's almost certainly basically there was lying, cheating, and stealing and dilution for UK to get involved. And then they won the war, but then all they did was feed an even bigger war coming after that, which hurt them even more.
Right. And I don't think the Financial Times admitted to their role in all of this for what, 80 years or something?
Literally 100 years later.
They retracted and 100 years later?
Yeah, something like 103 years later. The bank, it wasn't even them originally. It was the Bank of England when literally a blog, like Bank Underground, officials from the Bank of England went and pulled out their records from their basement. And they said, okay, here's actually what happened, guys. That war bond was never subscribed. We just basically printed it. And they went into actually oddly like blatant detail. And of course they called out the Financial Times, and the Financial Times was like, hey, so 103 years later, like a retraction we're happy to make. We said that war bonds were oversubscribed. Turns out they weren't. Happy to clarify. And then they kind of just like real briefly report on the story. But of course, nobody alive from the prior era was involved, so nobody feels guilt from it. You're just talking about what I don't feel guilt
Mm.
about what presidents in the United States did 100 years ago. And people at the FT did not care about what anyone did at the FT 100 years ago. So you just basically hid it under the rug for 100 years until nobody cared.
Yeah, I would have liked to have seen the institution have more of a remorse or something, a unified personality maybe, or credence throughout, or creed throughout the 100 years. I want to read a little bit more from your piece, from your book. Government debt levels across the developed world have reached levels similar to what they were in the 1940s. It may be harder for the government to repeat the same financial process this time. Back in the 1940s, the fiscal deficit and inflation that devalued the debt were triggered by war and could be turned off after the war was over. The developed countries still had young populations and low dependency ratios between elders and workers back then. In the United States in 1950, for example, there were 16 workers to support every retiree receiving Social Security benefits. In the 2020s, that number is now under 3 workers per retired beneficiary, and the decades ahead is projected to fall to as low as 2. Medicare has a similar top-heavy problem. We have made promises on our centralized flexible ledger that are challenging to back up by real-world resources. And the same is true for most developed countries in the world. Unlike the 1940s, there's no end in sight for the fiscal deficits that need to be run and which need to be financed at negative inflation-adjusted rates. Plus, we exist in the world of social media where people can rapidly share information of what's happening. So thinking about like long-term 80-year debt cycles and where we are now, do you think we're better off or worse off than we were during the Great Depression as a society?
I think it's hard to compare because if you look at energy per capita back then, it was a tiny fraction. I mean, my father was born in like World War II roughly. And if you look at oil usage globally back then, it was like 5 or 10% of what it is today, let alone natural gas, let alone nuclear. And so one thing I had an interview with Blockworks, talked to Jack Farley, and I was kind of like, we've almost had overlapping like golden ages. So like the 1800s and into the early 1900s were kind of like a golden age of money. But we were just kind of like figuring out dense energy sources at the time. And then that trickled into the current era where our money broke down, but we continue the trend of better and better energy sources and just more and more proliferation of existing energy sources. And so you can't really compare the two periods. I mean, you can't compare a period with a smartphone versus not a smartphone, or 10x the energy per capita as another period. If I were to roll the dice, most of the time I'd rather be born in the modern era. If I were to roll the dice and be born in the 1950s, I still would pick the modern era because unless I land in the US, I'm unlikely to have a better life. I mean, the US kind of was, 1950s, 1960s kind of considered like a golden age in the US, but it was just because the world, in large part, the rest of the world was devastated. So there's almost no one to compete. If you're not a white male, you're probably not going to be as of a golden age as others in that older period. And so is it kind of when we think of golden age, it's actually very narrow. And so there's really no other time or place in history where I'd want to be like randomly born than just today. But that's in large part because of our energy situation, which really just has been a continuous trend since the second half of the 1800s. Whereas our money system was the best back then. And I think that in the current trend, both our money's breaking down and our energy is unlikely to continue at the current trend that is as well, given current, kind of the way we're acting now.
So then along those lines, do you think that is the dollar losing hegemony? And would that be a bad thing?
So yes and no to both questions. It's losing hegemony in the sense that if you look at the percentage of U.S. debt that is held by the foreign sector, that's been declining for like 2 decades. If you also look at U.S. assets as a percentage of global assets, it's been declining. If you look at gold reserves of foreign banks relative to dollar reserves. Gold reserves were declining for decades in place of the dollar. But after the global financial crisis, gold reserves started going up and dollar reserves started going sideways. And so by those metrics, the dollar is losing out. As a percentage of global trade, like global contracting, global FX volume, the dollar's not really falling at all. If anything, the euro is falling and the dollar's kind of it's like China and other BRICS nations are kind of taking market share from Europe and the dollar's just kind of holding steady and not declining at all. And there's a very entrenched network effect from there's so much accumulated dollar-denominated debt because that's been the source of financing for most of the developing world. And all of that represents demand for dollars, and there's 13 trillion plus of it. And ironically, that's not even owed to the US. That's owed, like literally, China will lend dollars to Brazil, for example, or Germany will lend dollars to South Africa, whatever the kind of direction is. And so most of that you have non-American entities lending dollars to other non-American entities, but all of those dollars represent demand. All of those loans, that debt represents demand for dollars. At the same time, the U.S. the reason it's actually bad for the U.S. in a way is that I would separate two versions of the U.S. So there's U.S. the empire and U.S. the people. So U.S. the empire absolutely benefits from the dollar status. So if they can extend their reach globally, if they can get as much of a monetary premium as possible, then they can sanction any country. They get a lot of premiums for their money, and so they can have other countries finance their deficits at negative real rates and just kind of basically do that invisible tax to the whole world in a similar way that the UK did it during World War One. And that's very beneficial as the US, the empire. You can have 800 military bases. You can do all sorts of stuff. For America and the people, it's a mixed bag because in order to maintain the global reserve currency status, you have to export a lot of dollars to the world. If everybody needs dollars, you have to provide them with dollars. And the question is, how do you do that? And the ironic thing is that if you have it set up, the market forces do it naturally. Basically, there ends up being so much demand for dollars that it boosts the price of the dollar compared to the trade balance. And it increases the import power of Americans and it reduces their export competitiveness for anything other than like high margin intellectual property type of work or financial work or basically the treasury export business, tech, finance, government, healthcare. If you work in manufacturing though, or things that support manufacturing, you're probably gonna have a rough time. And your lunch is gonna get eaten by first it was the Germans, then it was the Japanese, then it was the Chinese, and then it was all of Southeast Asia, basically. And so we've basically hollowed ourselves out to maintain our global reach. So we're kind of like we're digging from like a reservoir of our own people in order for our elites, like our America the Empire people, to go out and try to keep maintaining their global status. So I think whether or not it's good for America depends on which section of America you're considering, because we keep digging ourselves into a negative, deeper and deeper negative net international investment position, which means that foreigners own a larger and larger share of American assets relative to how much assets we own of the foreign sector. So we're basically selling away our capital assets in order to maintain our trade deficits so we can supply the world with dollars so that we can maintain global hegemony status. But then why are we maintaining it if we're not actually if the average median American is not really benefiting from that? That's kind of the mess that we're in.
Right. And then changing perspectives a bit and backtracking. You mentioned in the book and online, you spend a little bit of time every year in Egypt. So you got to witness, that firsthand, that 20% annual inflation, maybe it's even higher. Was it life? What was like sort of the difference from year to year? Did you notice any change were people more frantic? Were people more concerned about inflation, or was it just life goes on?
So less than you'd think. but it's partially because it was always sort of there. So the way that Egypt works is that almost every year currency supply goes up by 20%. It's a very smooth line. Um, but they do their best to use their reserves, FX reserves, like sovereign reserves, to maintain a peg for a period of time compared to the dollar. So they kind of keep input prices lower, the local currency higher than it otherwise should be for like a multi-year period. And so inflation's always high, but it usually doesn't feel too different, too bad. And then it kind of all comes out at once, even though really, in terms of money supply, it was coming out continuously. Um, and from year to year, so I have somewhat of even there, I have somewhat of a privilege in the sense that most people I know are, you know, professional workers, small business owners, um, that they're comfortable people. They're middle class and above, generally speaking. And they are impacted by it, but not enough to dramatically change their lifestyles. So small business owners will change their import and export practices. A doctor I know is going to work in Saudi Arabia because he has trouble making the money he needs to make as ironically a doctor, a physician in Egypt. So there are these like professional choices that affect them. It's really the working class or the poor class that feels the most of the burden because like their carbohydrate meal. There's like I forget what it's called, unfortunately. There's like a classic carbohydrate meal. It's like rice and beans and there's a bunch of things mixed together. It's an inexpensive staple. And that has risen by a certain percentage. And that, of course, has dramatically hurt them, especially because the poor and the working class generally do a lot of cash transactions. They often save in cash, so they're not even earning interest on their cash. So, an upper middle class person will have a bank account. They're earning 15% as the currency is getting devalued by 20%. So they're at least, slightly treading water. Whereas if you're just holding $100 worth of Egyptian pounds in your shed, and then the currency is growing 20% a year, you're getting more rapidly devalued. Egypt has a pretty low percentage of people that have bank accounts. And so it's really, you kind of see that class by class by class interaction. And you see the small friction. So for example, if people feel bad about raising rents, the really the correct thing is to use to basically raise rents 20% a year. But that's assuming that the people can get 20% raises a year. And you feel bad if you're doing it on them, especially if you know the person you're renting to. So basically, the people that are kind of devaluing the currency are kind of preying on the fact that most people, especially small businesses or renters, know each other and don't want to immediately set prices higher. So they're all getting diluted to varying degrees as the people doing the currency devaluation are benefiting from it. And that's not unique. I mean, that happens everywhere in the world to varying degrees. And it's kind of it's been an interesting case study to watch. One, how bad it can be. Two, the details of how prices trickle through the economy. Three, how people deal with that. And then four, the more optimistic one is how life goes on. I mean, you know, like 3 years ago, people were going to work, going to restaurants, going to vacation. Um, my cousin's like little daughter was like watching Disney movies and wanted me to show me them. And then this year, everybody's, going to restaurants, going to work, going to vacations, and my cousin's, daughter wants to show me the latest Disney movies. It's kind of the same life, especially if you're kind of middle class or above, or even the working class. I mean, there's still it's still kind of the same thing. You wouldn't look around and notice anything different, but it's more of this pervasive background problem that sometimes gets worse, mainly around food or energy prices specifically.
Right. It reminds me when I was first starting out my career and I was living in Brooklyn, right outside of New York City. And I remember the first time my rent went up like 10 or 15% my first year. And I'm like, how does this work? Like, I only got like a 5% raise at work, and that was pretty good. That was with an excellent rating. And I just was like, well, I just rationalized it. I'll change jobs in a year or two and I get a bump that way. And this is for the privilege of living in New York City. And even now, I feel like things are breaking at the seams like underneath the surface at a society level, but I feel like everyone is just kind of holding it together as we go through what feels like to me 10 or 15 or 20% inflation here in America over the last, 1 or 2 years. And I wonder is the era of cheap money over forever? I wonder if these new 8% mortgages are going to feel inexpensive for the price of money, or to borrow money in a year or 2 or 3 years or 10 years.
So I think the rate of increase is quite aggressive. That generally tends to be unsustainable. So I wouldn't be surprised to see like a lower high from these levels. But I think the era of zero yields is behind us, especially on a sustained basis. I mean, maybe we briefly hit zero in like a deflationary crisis or something, but I think the era of 10%, you know, zero yields is behind us. And that was in large part because of the combination of how much debt was in the system and the commodity bear market that we were in. Basically, there was so much commodity capex in the decade prior. We had plenty of oil, plenty of copper, plenty of, XYZ, plenty of uranium. And going forward, we've kind of used up a lot of those prior capital expenditures. And so now things are a lot more tight. In addition, the demographics have changed. And so wage earners have a little bit more leeway. And so I do think that we're in a structurally higher inflationary environment, but I think it'll still have a cyclical element to it. I mean, the 70s were cyclical, the 40s were cyclical. Inflation tends to go up and go down and go up again and go down again. I think it's more like the lows and the highs are going to be higher than we've been accustomed to going forward for quite a while.
Along those lines, do you think a debt jubilee is in the offing? A modern day debt jubilee of some sort?
In some sense, that's kind of the inevitable mathematical outcome. And if you just look at things exponentially, eventually things get silly. So you have to think something nonlinear happens along this exponential journey. And then history provides some guide. So for example, the last time the Western sovereign debt as a percentage of GDP got this high was in the 1940s. And what a lot of these countries did was basically financial repression, yield curve control. So they said, well, I know inflation's averaging 6%, but we're going to hold yields at 2%. And, basically what it comes down to is if you're holding debt of a highly indebted entity, you're likely to lose part of your money. And if it's a corporation, you're likely to lose it nominally in the sense that they're going to default and you're going to lose some or all of your money. If it's a sovereign, you're likely not to default nominally, but you're likely to default through inflation. So it's like you'll get the dollars back, but they'll be worth half of what you kind of paid into that. And so they've defaulted in terms of growing their nominal GDP a lot quicker than they grew their debt load by printing a lot of money, which only works if they do financial repression, where they hold yields below the inflation rate for a long period of time. Now, the challenge is that the last time, emerging markets do that all the time. The multiple of them are doing it right now as we speak. It's hard for people to move assets out of the country to, even if they travel out of the country, they have all sorts of restrictions on how much they can spend on their debit card, for example. The financial repression happens all the time in those 160 different currency bubbles that I mentioned. But it's pretty rare, at least at an obvious scale, in developed Western countries since the 40s. And the problem is if they do that, I mean, now, unlike the 40s, we're in an area of social media, Bitcoin, stablecoins for other countries, and there's no unifying force that we're all kind of behind. So in the 1940s, Americans were broadly in support of government fighting the war, kind of this like, contribute buy war bonds. It was a very unified environment. And most of the world today is not like that. We just had a gradual decaying of our ledger. It's almost like the UK in the 1940s in that regard. And really the only kind of developed country today that's really fully together is Japan. They have a lot of unity, but most other countries don't. Like Europe has a lot of disunity, North America has a lot of disunity, and so I do think we're eventually over not next week or next month, but over the long term, we're heading towards a period of currency devaluation and kind of sovereign recapitalization is the polite word, or at least attempts at that in an era where someone's got to lose, which is primarily like the cash and bond holders. And that's going to be turbulent, I think.
Huh. Along those lines, you brought up something in the book that I don't think I was too familiar with, and you called it or it's called a legal clearing cycle. Maybe you could tell me what that is, and do you think we're going to go through something like that again?
So a legal clearing cycle kind of coincides with the financial clearing cycle, which is that when you get more and more debt buildup, eventually you get some sort of like Jubilee or just widespread. It's either basically things hit to a head, and either there's like a organized restructuring or a revolution, and they just kind of like break the ledgers, literally or figuratively. And the same thing kind of happens legally in the sense that if you keep adding laws and regulations and refining laws, you eventually get such a complex legal structure that it's hard to operate as a person, operate as a business. Um, the cost of like the overhead burden is very large, and it just gets super complex and bureaucracy builds up, and that's kind of part of the cycle. And then when there's a revolution, rarely do people just like, destroy all the money, but then leave all the laws in place. They just kind of start fresh or partially start fresh. And so you usually get like a legal clearing in that environment. And of course, the risk is that if you rely on very important things like a constitution or other things like that, that's basically like the gates are down in that moment. Like almost anything's up for change. If you have like a moment where the shields are down, the gates are down, things can change, including good things, right? So bad things can change for the good, or good things you've held cherished for centuries can change for the bad. And that's kind of the clearing cycle that cultures tend to go through. Historically, it also would happen just by war. I mean, if one country beats another country and conquers them, they have a legal clearing cycle. Or it can happen internally. They have debt build up, they have revolution from the inside, they have a collapse and a reformation, and they basically these financial cycles and clearings and legal clearing cycles tend to go roughly hand in hand.
Wow, that's interesting to kind of think of it that way. Do you think fiat ledgers could they ever go extinct?
I think they would go extinct if you had something so much better. I mean, it's funny how rare they were in history. They would be started and they would die pretty quickly, or they'd be localized. And it's because they were basically no faster or very little faster than gold and silver, but they were way less trustworthy than gold and silver. And so it was an obvious thing. You can imagine the platonic idea of money, which is that you have like a scarce thing that you can just like mentally teleport to people, that you can never get hacked, never lose it by accident. Nothing can ever equal the platonic ideal of money. But basically, if we could all beam like gold to each other in our heads, you'd imagine that fiat currency would have a much tougher time appearing. It only appeared because it abstracted gold, made it quicker and more efficient, and then when it all blew up, they just dropped gold from it and just kept the paper and the fiat, ledgers in the telecommunication era due to literally like a lack of any other known way to, you know, have a bare asset that transfers value quickly. If we can sustain things like Bitcoin that give us global settlements, and on top of that, Lightning and other kind of payment structures or other layers, it's very hard for fiat to compete with that. I think unless it gets broken or centralized in some way, if that just keeps growing and growing and growing, I think it crowds fiat out in a similar way that an emerging market over time mismanages its ledger, and eventually the dollar crowds it out more, but people just want dollars and they eventually get crowded out, and then fewer people hold the local currency and they lose their monetary premium. They have to print more just to afford what they're doing, and then they hyperinflate themselves. I think in the long arc of time, the same thing could happen to the dollar, the euro, and the yen by more and more people just not wanting to, as the paper system gets less and less stable, they opt into Bitcoin, and it's really hard to compete with that, and they just get crowded out over the long run. And maybe there are always attempts to like reform it, but then you're always like an uphill battle. In a similar way, if you were launching paper currencies against gold in a pre-telecom era, you're going to have a rough time. And if you're launching a new fiat currency against Bitcoin, if Bitcoin has won in a post-telecom era, you're going to have a rough time. And right now we're kind of in that intermediate phase. We're testing Bitcoin. We're watching it grow. We're seeing it gain liquidity. We're testing any attack surfaces it might have. We're seeing if anyone can figure out how to centralize it or exploit it, find something better. And just as we cross those things off the list, this thing just grows in monetary premium, and more people understand it and want to put a serious amount of their cash balance into it rather than their local fiat. And that just crowds out fiats at, even including over the long run, some of the bigger ones.
Thinking about cash balances and attack surfaces and how your book goes into speed of settlement, speed of transactions, I can't help but think about like digital bank runs, in the modern era and what we've already seen. But I wonder, do you think we're going to see sort of unprecedented movements of capital? Whether it's flight to quality, flight to safety. I'm not saying where it might go, but just, institutions dying overnight or newfangled ways to run on a bank that we might not be thinking about.
I think so, and there's two answers to that. So one is that even just in normal banks, bank runs can happen quicker now. So instead of people physically going to the bank, and there were techniques where you could like count the money out slower to them to try to slow down the bank run. Now you just have APIs. You can just pull it out, on a Tuesday at 8 a.m. But more broadly, what Bitcoin did was it brought the 160 fiat currency gates down. They're all vulnerable now, right? So if we think of countries, they have financial firewalls around themselves. They've really kind of two ways, primarily ways to bring capital in and out. One is through banks, bank transfers. And of course, the government just controls what bank transfers are allowed. These are large, centralized, controlled institutions, regulated, heavily regulated. Then you have ports of entry. How much cash or gold can you bring through a typical airport? Usually roughly $10,000 or less. Maybe a little bit more if you bring it through like in the form of Rolex, which is like non-fungible, right? So, if you go above the limits, you either got to do something illegal or which is hard, not recommended, or you got to do it in a non-fungible way, which hurts the monetary premium. So they have pretty tight controls on their borders. With Bitcoin, you can memorize 12 words or write them down in your luggage or whatever and bring $1 billion worth into that country. There's no value density. It's unlimited. There's no physical check. There's no way to prove you have or don't have it. I can pay even just not doing that. That's so ports of entry are crossed off the list now. And then for wire transfers to go around those, I could hire a Nigerian graphic designer and pay her. She can send me a string of numbers on email and I can send her back payment. She can show me a QR code on a video call and I can send her back payment. We just go around the banks. And so there's just all the gates are down on every country worldwide, which of course is more dramatic for countries where capital often wants to escape or even just capital wants to stay there, but people want to hold external capital. And then that actually also applies to stablecoins in the sense that, they're highly centralized, but the hub is not in the country that wants them, right? So if people in Argentina or Turkey or Nigeria or Lebanon want dollar stablecoins, and those are hosted in Italy or Switzerland or the US or Dubai or wherever, some entity can offer them dollars redeemable for coins that are available over, again, smartphones, QR codes, email strings, whatever the case may be. You can memorize words and bring them on a USB stick through an airport in unlimited amounts. And they're basically offshore bank accounts for the middle class in all these countries. People want dollars, T-bills, gold, whatever the case may be. So far, it's dollars. Maybe shares of the S&P 500. I don't know. But the point is, we have 160 different silos of capital, not just currency silos, but capital silos. So if you're a middle class Nigerian, you're kind of limited to what you can invest in. But if you could buy a share of the S&P 500 or own some claim to Swiss gold or own a dollar claim or a T-bill claim or preferably Bitcoin, either a fully decentralized asset like Bitcoin or a centralized asset whose hub is in a stronger jurisdiction, both of these things are just piercing through all of these currency walls throughout the entire world. And I do think that that's gonna be kind of like how the book publishers, the media companies have been brought to their knees by software. I think the next phase is the fireworks phase, which is basically sovereign currencies and sovereign borders, at least financially, the capital markets. That's what software is going after next, largely due to either Bitcoin or centralized tokenized assets whose hubs are in stronger jurisdictions. It's kind of like two options.
Wow. I'm kind of curious then, how do you think stable coins will drive demand for the dollar or more importantly, treasuries going forward?
It's largely a question, I think, of what the US wants to happen. Like, if they were kind of smart at extending their empire, they would try to proliferate them. Because even as sovereign countries try to de-dollarize, their people generally don't want to de-dollarize. Um, and it's, money is a market good. If you look in Austrian economics, money is a market good. And worldwide, dollars are, I forget the number, something like 60% of international transactions, or 90% of all FX trades, 60% of international transactions, whatever the case may be. And if you look at stable coins, they're 99% plus of stablecoin holdings, market cap, dollars. It's almost exclusively the world wants dollar stablecoins. And so the market, at least the fairly small market, but still a multi-10 billion dollar market, has chosen dollars. And basically, when you bring down silos, they can choose a better money. So if Bitcoin didn't exist, let's say you only invented stablecoins and Bitcoin didn't exist, you basically make it so that every fiat currency has to compete against every other fiat currency on a more fair basis. If a country like Argentina can't control its ports of entry or its bank transfers, in the sense that, Argentinians can just bring in or out unlimited amounts of dollars with them, or if any Argentinian can just do work for anyone outside of Argentina and get payment over a video screen or with an email or with a DM, that just changes. Like all that whole firewall is just shattered, right? And so now every fiat currency has to compete with each other. And then of course, when you throw Bitcoin into the mix, it competes even with the best fiat currencies. It's scarcer, it's more open, it's even less censorable. And so I think that stable coins on their own generally reduce the power of weak countries and increase the power of strong countries, mainly the strongest country, the US, unless or until the strongest country runs into its own fiscal spiral and kills confidence in its own currency. So it kind of potentially prolongs the empire era. But I think in the world of where Bitcoin also exists and indeed pre-exists those, it's kind of more of an intermediate thing. So as Bitcoin's growing, there are some people that have trouble with it because it's volatile, not just from an investment standpoint, but if you're a poor person in Lebanon, right? I mean, and you got like $100 you got to save from week to week, month to month, you're probably going to pick stable coins over Bitcoin. So in the intermediate term, people gravitate towards stable coins, and those who have some degree of kind of time delay can pick Bitcoin. But if Bitcoin gets bigger, more liquid, continues to be secure, that starts challenging even the big currencies like the dollar. It just takes time. You're going against a network effect that's tens of trillions of dollars in broad money, tens of trillions of dollars in overseas money, and then like $100 trillion in debt which represents demand for that currency, just globally dispersed, both in the US and then to a lesser extent outside of the US. So, we're like less than 1% of that right now. So we're going against a massive network effect. It's, you're trying to compete with like Facebook or Twitter, right? You're
Right.
you're going against the end boss.
Yeah, talking about the end boss, or just something I've been seeing. I mean, it's always, you could look at numbers that are released by government bureaus or economists, whoever, and you could debate how they're looking at numbers, how they're measuring things, what they're counting, what they're not counting. But it seems like there's been an increase in numbers being sort of just re-expressed. What we released a year ago is not what it should have been, and we didn't count this, this, and this. It's not so much we changed the denominator or the numerator. What do you see there? Do you see more fluidity and flexibility with the numbers that are being released and then them being revised? And if so, how do you deal with that as an economist?
So that depends partially on what time frame you're looking at. I would say in the past 5 years, inflation metrics have not changed too much, if at all. It depends on the country you're talking about, but basically, um, revisions are a normal part of economic analysis because a lot of the calculations are kind of like bullshit in the intermediate term, like in real time, and then they kind of solidify them over the long term. And that's not a new thing. That's just how it works. So the key thing there is consistency. If you're bullshitting, at least do it consistently, because then you know, you're you're at least doing the same thing, right? Now, over the longer term, the inflation metric has changed. It changes how it does shelter, for example. It takes into account the fact that, if people substitute, if ribeye gets too expensive and they buy ground beef, and then ground beef gets too expensive and they buy chicken, and then chicken gets too expensive and they buy soybean, you know, um, they kind of recursively go down to whatever's cheaper. Um, so I think there's merit in looking at alternative inflation calculations. I personally like to look at the money supply growth because the way I spend less time thinking about the accuracy of CPI and more time looking at the spectrum of things compared to money supply. So money supply is going up at a certain rate. Now, the funny thing is we don't even know for sure if that's true because we can't audit it. It's not Bitcoin. There's only one node and we don't control it. It's not open source. But these things are, fairly consistent, fairly open as far as we can tell. So we have data and we say, okay, here's the money supply. And you can kind of piece it together also, like if you add all the commercial banks statements together, you can kind of recreate what the government says money supply is. So you can find out whether or not it's roughly true, unless like, tons and tons of people are all lying to you in a way that agrees with each other. Um, so basically you have a rough idea what money supply is, probably accurate. Um, and then you say, okay, there's a spectrum below this over a multi-decade time frame. So things that are very scarce, like waterfront property or a Van Gogh painting, things that they're not making literally any more of, will generally go up in price with money supply growth. Because it's not that things go up in price, it's just that you're diluting the unit that you're measuring that thing in, and that's roughly holding firm. Um, Things that we can make a little bit more of, like gold, oil, the average house, or things that are labor intensive, like hospital services, childcare services. These things tend to go up at higher than the rate of CPI, but lower than the rate of broad money supply growth, because we're getting somewhat more efficient at making them. And so that delta between money supply growth and the price of that good or service is generally like roughly our productivity rate. Um, and then there's things we get way better at, like making wheat or soybean oil or Chinese plastic goods or software or a gigabyte of storage. Um, Things like that go either down or exponentially down in price, and that all gets weighted into CPI as well. And so that's those things are below the average CPI, and so CPI is kind of like the lower end of this. And so I think the reason that a lot of people kind of feel inflation's above the CPI is because the inflation of things of the semi-scarce basket that they want, the median home, the nutrient-dense food, the good health care, the child care, the good health care, the ability to travel to to the Bahamas once a year, whatever, wherever you go, some sort of like nice trip. Um, that basket is indeed growing faster than CPI. And even if you look at it in the data, you can still find that generally to be the case. And so it's not so much that I think the data has been like rapidly changed in the past few years. It's that the data changes occasionally, um, and that it's always imperfect to begin with, and that it's kind of tailored to optimize towards things that get cheaper.
Such a rational perspective. Thinking along, just kind of trying to, I'm curious whether, as an engineer, economist, and monetary historian, do you think the Bitcoin network is robust enough for the long run?
So I think so. I mean, that's obviously I'm not sure anybody knows because that's a multidisciplinary field. Like even Satoshi didn't know. He wrote himself that in 20 years, either the Bitcoin network's going to have a tremendous amount of volume or no volume. So if Satoshi doesn't know, I can't claim that I know, right? I think that people who claim to know today are basically claiming more knowledge than Satoshi claimed. And of course, we've got another decade and a half, roughly, or decade and a third since Satoshi. So we have more information to work from, but we're also, it's hard to compare ourselves to Satoshi, right? So I don't go out and say like, look, I know things that Satoshi didn't know, but instead I just look at this. Okay, so it's an economic question, it's a software question, it's a geopolitical question. What is the probability that the U.S. decides to go all in on it while it's weak, for example? So that's actually arguably why Satoshi disappeared, is that after WikiLeaks turned to using Bitcoin, he was like, "This is like going to be like a swarm of hornets at us. Like, I'm not sure the network's ready for this." Um, and even today is, in its $500 billion state, if the U.S. military were basically to declare war on Bitcoin, is it ready for that? I'm not. That might be. Maybe we're not ready for that boss yet. We have to clear a couple mini bosses before we get to that boss, and that we hope that there's enough geopolitical obfuscation, confusion, bureaucracy to prevent them from even trying something like that until Bitcoin is big enough and leveled up enough that even if they were to try that, it's like ready to absorb that now. And so we're talking economically, like are the incentives, do they make sense long term? Software wise, is there a bug we don't know about? There have been bugs in the past. It could survive bugs when it was in like like a hobbyist stage. Could it survive a critical inflation bug when it has a trillion plus market cap? That might, kill confidence in it for the long term, which is why I think we should be very conservative with upgrades. And that's also why I don't consider it invincible. If I consider it invincible, I'd be like, yeah, upgrade it whatever you want. It's invincible. But I don't consider it invincible, which is why I'm like, maybe triple check everything before you upgrade it. Because the last thing the thing we can't have is like an inflation bug, basically. Or some sort of other critical error. I think there's questions around the supply chain centralization. So I'm not super worried about mining pool centralization or mining centralization. I think there are some reasonable concerns there, but there's nothing particularly concerning because, miners can always switch to other mining pools if there's a major issue. Mining itself is still pretty decentralized. The biggest miners have like 5% of the network. I would like to see a little bit more mining outside of North America, but we're already better than how centralized we were back in China in the day. So it's directionally getting more decentralized. I think there's a risk in terms of how much chip making is done in basically there's like three foundries in the world that can make like hyper competitive Bitcoin chips, which is not great. But that's actually true for almost any semiconductor. So that's a semiconductor problem that happens to also affect Bitcoin, which we care about as making it the next like base layer of money. Um, but that's actually an even bigger problem than just Bitcoin. But if we consider Bitcoin a really big thing, that's a big problem. So there are companies like that are trying to diversify that. You want to have top tier chips made in like US and Taiwan and South Korea and hopefully elsewhere, not just, not you want to have like 10 countries that can make hyper competitive Bitcoin chips, not just three. Um, so I think that's if the US government were to like go to the mattresses on Bitcoin, you'd think, okay, well, take over the foundries, sanction the foundries, get the production, determine what every miner in its own hash rate can do, ban the export of miners from the country under threat of imprisonment. There are ways to attack the network. I mean, they could spend $10 billion to spam the network, which would feed the miners. But if they also control 40% of the miners, and then they're trying to sanction external ones and gain supply chains, there's edge cases where scenarios could go after the Bitcoin network, but the bureaucracy and there's a social layer against that. Like imagine if the Pentagon was spending taxpayer dollars to attack the Bitcoin network. Like how would that go over? And imagine like some of the members of Congress like pulling, the generals into the Congress and be like, what are we doing exactly? And that's like televised. So there's a social layer there. That's actually why I think that engaging politically is non-trivial. Like that's why it's important to get in the US, you want to get a bunch of Republicans on your side. And then there's people like Jason Meyer that are writing the progressive case for Bitcoin, or others that are trying to explain why Bitcoin's not the environmental mess that a lot of people on the left think it is. Because if you can get the most of the right and then a fraction of the left, you can prevent like a supermajority from ever forming against you. Like, FDR, when he did the ban gold thing, he had 70% in Congress, like in his party. He could stack the court. He could do whatever he wanted. He controlled every lever of government was controlled. If you can maintain some degree of polarization on your side, where there's at least a firm minority, let alone majority that supports you, but let's just say a firm minority, it's hard to get these extreme actions. So I think the combination of Bitcoin being well designed, economically great for 15 years almost running, and then just a couple of people doing their best on the social layer, the government layer, to try to mitigate the probability of extreme outcomes, gives it more time to keep growing and proving how robust it is. And I think it is robust.
Wow. Well, that's reassuring to hear. What do you think would be some negative or if any, would be some negative outcomes directionally that we could get if we went on a Bitcoin standard?
I think we'd have to separate the long term from the transition period, and it's hard to conceptually separate them ahead of time. But basically, I think that you'd have almost like a cyber feudalism is probably one of the downsides to consider, which is that the richer you are, the more portable your capital is. And so rich people can kind of go to enclaves, whereas poor people can't realistically move. They don't have the resources to. And so it's arguably, I can see why people from a class warfare perspective, like even well-meaning people, would look at this and say, so what you're saying is that you're going to increase the portability of like the upper middle class and above, and not really necessarily do a ton for everyone else, right? And I think there could certainly be a period where that happens, especially if rich people are more financially savvy and educated and they buy Bitcoin first. And if Americans buy all the Bitcoin before, Egyptians or name your country, right? It's like, so we just made the rich people richer and then also gave them more portability and global optionality. I think that's kind of the reasonable concern around this period. But that, I mean, for example, when the Soviet Union fell, the rise of the oligarchs happened because there were a lot of people that were either tied into the existing system or they were otherwise business savvy, and they claimed all the assets. And then they kind of entered a new regime. So like the way that a prior regime falls contributes to how the next regime rises. And it's good and bad, but it's somewhat inevitable, right? It's hard. So I think the transition period is going to be challenging. And I think that will be probably politically used against Bitcoin. Again, considering that if it is as successful as we think it will be, if it starts to actually, if it's powerful enough to start having these effects, the kind of the last layer we have to consider is like as it's winning, like thoroughly, there's going to be pushback. So look what's Bitcoin's doing to us. And of course, it's a combination of it's mostly what are fiat ledgers doing to themselves, right? So it's not Bitcoin that's wrecking. Argentina does not have 140% inflation because of Bitcoin, and it doesn't have 140% inflation because of the dollar. But the fact that those exit valves exist, people will blame it. They'll be like, look, there's these like Bitcoin people, there's these or these speculators getting dollars. It's their fault that our currency is failing, right? That happens in developing countries today. Imagine if the dollar or the euro or the yen fall, imagine some of the political backlash. Like look at all these Bitcoiners that helped kill the dollar, right? So I think there would be political turmoil and those who understood it benefiting and becoming oligarchs, and that not necessarily being an amazing thing in that like intermediate term. I don't think there's like a utopia 10 years from now that some Bitcoiners imagine where things just magically get better in 10 years. I think it's to the extent that it's successful, it's a very rough transition period. And it might take another couple generations for things to kind of fully even out and actually kind of distribute back down to like what is normal. Um, so I think that's kind of the major downside. I mean, other than that, I mean, I don't think there's much downside to like transparent, honest money. Giving people the ability to like move their value portably, to be able to claim their own work, right? I think in the long arc of time, there's nothing bad about this. It's only about the transition period. But unfortunately, I would define the transition period as decades, right? So generations. I think that's a realistic concern.
Do you think the notion like that Hayek brought up of separating money from state is something that we need to do for humanity, or is that something maybe less consequential, and these monetary systems can maybe coexist for different reasons, or maybe whether they could coexist, maybe we don't need them to be separated. Do you think that's something important?
I think at the bare minimum, it's important for people to have optionality, right? So people in Nigeria shouldn't only have access to Nigerian currency, Nigerian assets, for example. Just as if you roll the dice and think where you're going to be born, do you want to have access to only your country of assets and currency? Probably not. You're entirely reliant on that. Um, and like it completely controlled in like a surveilled, centralized way, in a way that was not available even in medieval times. You know, other things were worse in medieval times, but the degree of financial control and surveillance is worse today, even as most other things are better. And so I would say that it is important to separate, or at least give at the bare minimum, give the optionality. But then if you have a money that's so much better that everyone in the world wants it and it perforates every border, it's hard to not imagine that that will push into every fiat currency. And maybe, maybe the last two standing are like the dollar and the Chinese yuan, for example, right? And maybe there's five currencies standing. And the whole developing world kind of is like fallen to Bitcoin and the dollar. And, like it's hard to imagine the scenario this works out. But I do think that right now we equate currency with the state on average, kind of like how people equated religion with the state. Like you just assumed that they're tied together. It's just that's how it always was. Because if you don't have the printing press, how do you even learn about other religions existing, right? Or how do you even there's limited long distance communication. Like your religion and your state and your community are all kind of the same thing, right? And so the idea of separating them is complicated. Um, Whereas once you invent the printing press and then the telegraph, and you realize, okay, information can go anywhere. We can have a country that all sorts of people can study any religion in the world. They can all immigrate, and a bunch of them immigrate, and like so we say, okay, people can have any religion they have. So now there's the obvious need to separate religion from state, large part due to technology. And then retroactively, we say, sure, they should have always separated it, but we can say, well, it didn't really need to separate it too much until it was like all this information could just spread super quickly. And I think the same thing's true for money. Once you can perforate all the borders and money can just flow everywhere, it just kind of works itself out and starts to assert that it should be separated in a similar way that it becomes increasingly ethical to say in this region you can only be this religion, or in this region you can only be this communist party or political party, or in this region you can only use this money. The more things are capable of spreading globally, whether it's information or value, it becomes increasingly untenable to have the state control that, which is still different than saying there's no state, because I think there's a natural vacuum of power that tends to develop. I don't think it's an accident that there's no ungoverned areas right now. Now maybe technology changes how power structures evolve, but it is to say that even if there's a state, that money doesn't necessarily have to be part of it in a similar way that a political party doesn't have to be part of it, or a religion doesn't have to be part of it. Countries generally do well when they have some sort of shared values, at least, a founding document or a motto or, some sort of framework that kind of defines that country besides just borders. It's not just like a random bunch of people in a border. Uh, but it really doesn't have to be money at all.
Lynn, I've enjoyed this conversation immensely. The book is a tour de force. It really ties together politics, unified theory of money, monetary history, banking, and then it's really fascinating. He spent a lot of time in the end of the book talking about financial technology and surveillance and monetary colonialism. So, my final couple questions for you: has Bitcoin changed you at all?
I mean, I think it's given me more hope in the sense that a lot of my work was studying the problems with the financial system. And so the more that I could see solutions for those problems, the more I wanted to lean into them. And that's why, for example, rather than just analyzing this, I also work with Ego Death Capital, where we actually, we do venture capital in the Bitcoin space, right? I mean, it's, it's the desire to, if I see investment opportunities and want to fix problems, capitalism is about trying to identify problems and fix them, or find people that can fix them, get them capital, and help them fix them, right? And so um, it's given me I think, a more constructive view on how to fix this. I see a clear direction, and I can never know for sure if that direction is going to succeed, but I think this is clearly the right direction that should succeed. I hope it succeeds, and I'm happy to devote my time to doing everything I can to help it succeed. And then also it's just it kind of puts older theories in a new light. The reason knowledge evolves is that we learn something which not only gives us new information, but then lets us see why a prior theory might have been 90% correct, but maybe it has another 10%. Like, for example, Newton's theories were amazing at the speeds and times like that we normally operate at. But if you operate at extreme speeds, Newton's theories break down. And we actually find out there's like another 10% that actually ties things together more completely. That's Einstein. But you don't notice it until you get to that point. And I think Bitcoin's kind of like that, where it ties together things from 100 years ago in a way that you couldn't know until you found Bitcoin. And then that goes and rewrites or adds to some of the prior literature. So I'd say those are the two ways where Bitcoin's changed. I mean, it's added to prior literature with a new light, and it turns kind of complaining about the system into wanting to build a new system.
So, my final question for you, and this one's a little hard to articulate, but and nothing on this show is financial advice, and I'm not asking you to give that. But when I read your work, I get this sense of poise, of calm. Sort of, we're looking at the facts, we're looking at what we can see, we're very measured, and I think that could be sort of missing from a lot of people's mindsets towards economics or portfolio construction or finance or how to manage their finances. So, not financial advice, but what kind of advice would you give to people to kind of, maybe especially going through the next couple of years, like how to deal with, I don't know if it's finances or economics, or just sort of looking at the world and not jumping to conclusions, maybe not, I get it. What Lynn said, Bitcoin's going to win. Let me go 100% Bitcoin. Let me still be reserved and rational and have a smart approach to what's happening, and be reserved and have a long-term mindset.
So my first philosophy is that I only go 100% in something I consider 100% risk-free, which is nothing. So I never go 100% in anything, because I would never want to be in a position where I work for 20 years and then have nothing because of the tail risk that I was wrong about something, or something outside of my control hurt that, right? So always a baseline level of diversification. That doesn't mean, 5% in every asset class, equally diversified, totally passive. It doesn't mean that, but it just means like, here's my A game, like my A plan, here's my B plan, here's my C plan in proportion. Here's my backup for if my major plan doesn't work out. And so, I mean, for example, I'm bullish on Bitcoin. I'm bullish on energy as an industry. I'm bullish on having some degree of control of your surroundings. So that can include owning real estate and having just, you know, resources, stockpiles, connections around you. So I think that's, there's a case for owning real estate and energy assets and Bitcoin and maybe some degree of income producing assets so that no matter how volatile Bitcoin is, you never have to sell your Bitcoin, right? Your expenses are hopefully covered by your other cash flow producing assets. So I think basically if I'm bullish enough on Bitcoin that I don't need it to be 100% of my net worth. Because if Bitcoin goes up at the percentages I think it does, it's more money than I need. And so I want to have all the upside, or at least a lot of the upside, but also protect my volatility. Now, we can imagine, let's say the US just bans Bitcoin, goes all out, tells every institution they got to sell it, illegal to own it, right? What is the percentage that happens? And what do you do in that scenario? Even if you're non-American, I mean, the liquidity just got killed. The price probably just got crushed. And unlike a normal cycle, maybe it takes 10 years to rebuild back. Maybe it takes 5 years. I don't know, right? I mean, even if you think, okay, Bitcoin survives this, it's not going to be over next year, right? And so you just have to consider there are scenarios where even if Bitcoin succeeds, Bitcoiners could be, challenged in various jurisdictions or based on price or, just pressures. And you have to have the resources and optionality to get through that. And so I would say, study assets, study money. This is an era where studying money and energy, I think money and energy, understand both those topics very well. Because I think that that's kind of the transitional epoch that we're in right now. And geopolitically, financially, those are things to be a well-informed person on. And then the more you study them, the more I think you can make your own decisions on how you want to allocate.
Lynn, this has been so dope. I think it was, I don't know where I saw it, but I think you also mentioned that something about broken energy. And so maybe your next tune will be broken energy instead of broken money. This has been incredible. Lynn, you please let people know where they can find you and your work.
So I'm at lynalden.com. That's where my research is. They can check out at Lyn Alden Contact on Twitter. They can check out my book, Broken Money, on Amazon, or thesafehouse.com. SAIF. That's it's how do you spell safe? There are a couple of different ways to buy it, but check it out.
Yeah, book's amazing. Look, you can see I marked it up. We didn't even get into so much of it tonight, and it's incredible. Thank you so much. Thank you.
Thank you.
Hey, that's a wrap on today's episode of the Bitcoin Matrix podcast. I hope that you found it informative and engaging. Hit us up. We'd love to hear your feedback. I'd like to thank you and our sponsors for tuning in and supporting the show. Keep building, keep stacking, stay laser focused out there, and let's free Ross. This is Cedric. Peace.